This audiobook is a journey through the art of uncovering stocks trading below their true worth. You'll learn to sift through financial balance sheets, identify real competitive moats, and build a long-term, robust portfolio, all without a Wall Street pedigree. Chapter 1. The Sleeping Giant, Spotting Undervalued Stocks. When most people think about investing, their minds jump to flashy, high-growth companies making headlines, tech giants, hot startups, or trendy industries. But here's the thing. The best opportunities often aren't where everyone is looking. They're hiding in plain sight, overlooked, and undervalued. Finding these sleeping giants isn't about luck or insider information. It's about knowing where and how to look. And the good news? Anyone can do it, even if you've never bought a stock in your life. Let's start with a simple idea. Not every cheap stock is undervalued. A stock's price alone doesn't tell you whether it's a bargain or a trap. What we're looking for is a stock that's worth more than what the market currently believes. Think of it like this. Imagine you're shopping for a car. You come across a used car that's selling for $10,000, but after doing some research, you realize it's in excellent condition, has low mileage, and similar cars sell for $15,000. That's a deal. Stocks work the same way. So how do you find these deals? The first step is learning to screen for undervalued stocks. Most brokers and free tools online offer stock screeners. These are like search engines for the stock market. You enter specific criteria, and the screener gives you a list of stocks that match. For beginners, the price-to-earnings ratio, or P/E ratio, is a great place to start. This ratio compares a company's stock price to its earnings. In simple terms, it shows how much investors are paying for each dollar of profit. Here's how to use it. Look for companies with a P/E ratio lower than their industry average. Let's say the average P/E for the tech industry is 25. If you find a solid tech company with a P/E of 15, you've got a lead. But don't stop there. This is just the starting point. Now, let's address a common pain point. How do you know if a low P/E is a sign of value or a red flag? Here's where digging deeper pays off. Start by checking the company's earnings history. Is it consistently profitable, or are its earnings all over the place? A company with steady earnings is often a safer bet. Next, look at its debt. Too much debt can sink even the best business, so make sure the company's debt levels aren't dangerously high. Another powerful tool is the price-to-book ratio, or P/B ratio. This compares a company's market price to the value of its assets. Think of it like buying a house. If the market price of the house is lower than the cost of the land and materials to build it, you've likely found a bargain. For value investors, a P/B ratio under 1 can signal a sleeping giant. But again, context matters. A low P/B in a struggling industry might reflect deeper issues, not hidden value. Let me give you a real-world example. During the COVID-19 pandemic, many travel companies saw their stock prices tank. But not all travel companies were struggling equally. Take a company like Booking Holdings. It had a strong balance sheet, lots of cash on hand, and a history of bouncing back from tough times. While its stock price plummeted, its fundamentals remained solid. Investors who recognized this and bought in at the lows saw significant gains when the travel industry recovered. Now, let's get practical. Here are 3 simple rules to follow when spotting undervalued stocks. Focus on companies with strong fundamentals. These are companies that make money consistently, have manageable debt, and are leaders or strong competitors in their industries. Avoid the hype. If everyone's talking about a stock, chances are it's already priced high. Look for companies that are quietly doing well, not the ones making headlines. Be patient. Value investing isn't about quick wins. It's about buying solid companies at good prices and letting time work in your favor. Lastly, let's tackle fear. The fear of making a mistake, of picking the wrong stock. Here's the truth. Even the best investors get it wrong sometimes. The key is to limit your downside. Don't put all your money into one stock. Diversify across industries and companies. That way, even if one pick doesn't pan out, your portfolio can still thrive. By following these steps, you'll start to see the market differently. Stocks won't just be random numbers. They'll become opportunities, each with its own story to tell. And the more you practice, the better you'll get at spotting the sleeping giants. So, grab your flashlight and start your search. They're out there, waiting for someone like you to wake them up. Chapter 2. The Treasure Map, Navigating Balance Sheets. When you hear the words balance sheet, your first thought might be, that's for accountants, not me. But let me let you in on a little secret. You don't need to be a financial wizard to read one. Think of a balance sheet as a snapshot of a company's health. It's not as intimidating as it sounds, and once you get the hang of it, you'll wonder how you ever invested without it. Let's break this down. A balance sheet has three main parts: assets, liabilities, and shareholders' equity. Picture a teeter-totter. On one side, you have the assets, or what the company owns. On the other side, you have liabilities, what the company owes, and shareholders' equity, the leftover value for investors like you. The two sides always balance out, hence the name. Let's start with assets, the lifeblood of any business. Imagine you're looking at a company that owns office buildings, has cash in the bank, and sells software. On the balance sheet, these are split into two categories: current assets and non-current assets. Current assets are things that can be turned into cash within a year. Think cash, inventory, and accounts receivable, money customers owe the company. Non-current assets, on the other hand, are long-term investments like property, patents, or machinery. Now, here's the first actionable tip. Pay close attention to the cash position. A company with little cash on hand might struggle to pay its bills, no matter how profitable it is on paper. For beginners, cash is king. You want to invest in companies that can weather storms, and a healthy cash reserve is your safety net. Next up, liabilities, or the company's debts. These are also split into two groups: current liabilities and non-current liabilities. Current liabilities are debts the company needs to pay within a year, like supplier bills or short-term loans. Non-current liabilities include long-term loans or bonds payable years down the road. Here's the second tip. Compare current assets to current liabilities. This is called the current ratio. Divide current assets by current liabilities. If the number is above 1, the company has enough short-term resources to cover its short-term debts. If it's below 1, it could be a red flag. For instance, imagine a tech startup with $2 million in current assets, but $5 million in current liabilities. That's a problem because it means they're relying on loans or future profits just to stay afloat. Now, let's talk about shareholders' equity, the part of the balance sheet that belongs to you, the investor. Shareholders' equity is what's left over after a company subtracts its liabilities from its assets. It's often referred to as the book value of the company. If you've ever heard someone say a stock is trading below book value, they're talking about this number. Here's another key tip. Keep an eye on retained earnings, a line item under shareholders' equity. This shows how much profit the company has reinvested into the business rather than paid out as dividends. Consistently rising retained earnings can signal a well-managed company focused on growth. Now, let's address a common pain point. How do you know if a company's balance sheet is strong enough? One simple rule of thumb is to look for low debt levels relative to assets. This is called the debt-to-asset ratio. Divide total liabilities by total assets. A lower number is generally better. For instance, a consumer goods company with a 30% debt-to-asset ratio is in much better shape than one at 80%. Another actionable tip: look at the quality of the assets. Not all assets are created equal. For example, cash and short-term investments are solid assets, but inventory can be tricky. Imagine a fashion retailer with $10 million in unsold clothes. Those clothes might lose value quickly if they go out of style. This is why you should focus on companies with tangible assets, things like cash, property, or equipment, over intangible assets like goodwill, which can be harder to measure accurately. Finally, let's bring it all together with a story. Imagine you're evaluating two companies, Company A and Company B. Company A has $100 million in assets, $50 million in liabilities, and $50 million in shareholders' equity. Its current ratio is 2, meaning it has twice as many current assets as current liabilities. It also has $20 million in cash and a low debt-to-asset ratio of 25%. On the other hand, Company B has $100 million in assets, but $90 million in liabilities, leaving only $10 million in equity. Its current ratio is below 1, and it has almost no cash on hand. Which company would you feel more confident investing in? Company A, of course. By simply reviewing the balance sheet, you've avoided a potential disaster with Company B and chosen a business with solid fundamentals. That's the power of understanding a balance sheet. It gives you a roadmap to make informed, confident decisions. So, next time you see a balance sheet, don't shy away. Embrace it, because buried in those columns and rows is the treasure map to your next great investment. Chapter 3. The Earnings Riddle: Separating True Profits from Illusions. When you first glance at a company's earnings report, the numbers might look impressive. Revenue is up, net income is solid, and the CEO is singing praises on the earnings call. But here's the catch. Not all profits are created equal. In fact, some profits are illusions, temporary gains that can evaporate overnight. Learning to separate real, sustainable earnings from accounting tricks and one-time windfalls is the key to making smarter investment decisions. Let's dive into how to crack this earnings riddle without needing an accounting degree. First, let's talk about the income statement. It's the document that tells you how much money a company made or lost over a specific period, usually a quarter or a year. Think of it like a report card. The big number everyone obsesses over is net income or profits. But here's the problem. Net income can be manipulated. It's not always the best reflection of a company's true financial health. Take one-time gains, for example. Imagine a company sells a piece of real estate it's owned for decades. The sale might bring in a massive profit, and that profit will show up in the net income for the quarter. But does that mean the company's core business, the thing it's supposed to be doing to make money, is thriving? Not necessarily. This is why you need to dig deeper than just the headline numbers. Here's a real-life example. Back in 2019, a big-name retailer reported a massive spike in profits for the quarter. Investors cheered, and the stock price jumped. But if you read the fine print in the earnings report, you'd notice something odd. A huge chunk of that profit came from selling off some of its store properties. The core business, selling product to customers, was actually struggling. Investors who missed this detail and bought the stock based on the headlines ended up losing money when the truth came out in the next quarter. So, how do you avoid falling for these traps? Start by focusing on a metric called operating income. This is the profit a company makes from its core business activities, before things like taxes and interest payments. It's a cleaner, more reliable measure of a company's performance. You'll find operating income listed on the income statement, usually a few lines above net income. If operating income is growing steadily, that's a good sign. If it's flat or declining while net income is soaring, it's a red flag. Next, look for non-recurring items in the earnings report. These are one-time events that boost or drag down profits temporarily. They might include gains from selling an asset, restructuring costs, or legal settlements. Companies are required to disclose these items, but you often have to dig into the footnotes or the management discussion and analysis section of the report to find them. If a company's profits rely heavily on these one-offs, be cautious. Sustainable growth doesn't come from a lucky break. It comes from a solid business model. Another tip: pay attention to cash flow. Unlike net income, which can be influenced by accounting rules, cash flow shows you the actual money coming in and out of the business. Specifically, look at cash flow from operations in the cash flow statement. If a company's net income is rising, but cash flow from operations is shrinking, that's a red flag. It could mean the company is using aggressive accounting techniques to inflate earnings. Let's make this actionable. Imagine you're evaluating a tech company. Its net income is up 20% year over year, which sounds great. But when you check the operating income, you see it's only up 5%. Then you dig into the earnings report and discover the extra profit came from selling patents. Finally, you look at the cash flow statement and notice cash flow from operations is actually down. Now you know this company's earnings growth isn't as impressive as it seems. One more thing to watch for is the quality of earnings. This refers to how reliable and repeatable a company's profits are. High-quality earnings come from core operations and are supported by strong cash flow. Low-quality earnings come from non-recurring items, accounting gimmicks, or aggressive revenue recognition practices. A quick way to gauge earnings quality is to compare net income to cash flow from operations. If cash flow consistently lags behind net income, the company might be using accounting tricks to prop up profits. Let's recap with 3 simple rules. Always check operating income first. If it's not growing, don't get too excited about net income. Dig into non-recurring items. Be skeptical of one-time gains or unusual events that inflate profits. Compare net income to cash flow from operations. If cash flow doesn't match profits, something's off. Earnings reports can be intimidating, but they don't have to be. With these tips, you'll be able to cut through the noise and focus on what really matters. Finding companies with sustainable, high-quality earnings that can fuel long-term growth. Because in the end, the stock market rewards substance over style. And now, you know how to tell the difference. Chapter 4. The Moat Mystery, Identifying Durable Competitive Advantages. I know you've seen headlines lauding the next disruptor destined to crush incumbents, and maybe you've lain awake worrying your own pick could disappear overnight. Here's the truth. Some companies build walls around themselves, a moat that keeps competitors at bay. Imagine 2 friends. One buys shares in a budget clothing chain, the other in a heritage brand whose logo screams trust. When sales slump, the heritage brand weathers the storm. The budget chain doesn't. That's the power of a moat. In this chapter, we'll zero in on real-life moats and, more importantly, 6 actionable rules you can use today to separate lasting businesses from flash-in-the-pan fads. First, let's define moat in plain English. It's an edge a company can maintain for years, stopping rivals from stealing market share. Think of Amazon's warehouse web or Coca-Cola's global distribution system. These aren't lucky breaks. They're deliberate defenses. But how do you spot them without a finance degree? I've broken it down into clear steps. Rule 1. Look for consistent, above-average margins. Moats often show up in profit margins. If a business consistently pulls 25% on every sale while peers struggle at 10%, that's a beacon. As a beginner, scan free financial sites, Yahoo Finance, Google Finance, or the company's SEC filings. Pull the gross margin and operating margin over the last 5 years. If margins stay high and don't collapse when sales dip, you've likely found a moat. For example, consider premium coffee chains. They routinely maintain gross margins north of 60%, thanks to brand cachet and customer loyalty. Rule 2. Gauge customer switching costs. Picture your team's project management software packed with files, workflows, and integrations. Moving to a competitor means hours, maybe days, of painful transition. High switching costs lock customers in. To test this, pick a company and ask, would a customer dread leaving? Look at business software providers, insurance policies, or even gym memberships. High churn rates flag weak moats. Low churn, strong ones. For instance, Salesforce holds corporate clients with decade-old contracts because integrations and training cost too much to rebuild elsewhere. Rule 3. Check legal and regulatory barriers. Some sectors rely on patents, licenses, or government protections. Pharmaceuticals patent life-saving drugs, utilities win regional monopolies, and telecoms guard spectrum licenses. As a beginner, search intellectual property or regulatory in annual reports on the SEC's Edgar site. Count active patents, licenses, or exclusive permits. If a medical device firm holds 20 patents on a heart stent extending into 2035, it's protected from copycats. That legal moat forces competitors to innovate from scratch or pay hefty licensing fees. Rule 4. Spot network effects. Network effects mean the more people who use a product, the more valuable it becomes. Social networks, ride-sharing apps, and payment platforms live here. To evaluate, ask, does each additional user increase the product's value for everyone? Think Visa or PayPal. Every merchant who signs on attracts more buyers. Every buyer who joins draws more merchants. If a platform's value grows exponentially with its user base, you're looking at one of the strongest moats out there. Rule 5. Observe pricing power over time. A true moat lets a company raise prices without bleeding customers. Grocers can't randomly jack up milk prices, but Apple routinely adds $50 to new iPhone models and still sees pre-orders surge. To test this, compare average selling price to sales volume over several quarters, data you'll find in earnings presentations. If revenue climbs even as prices rise, you've uncovered genuine pricing power. That's a moat you can bank on through inflation or rising costs. Rule 6. Verify market share stability or growth. Finally, a moat shows up in market share that holds steady, or better yet, grows, despite competition. As a beginner, look for industry snapshot reports on free sites or summaries in annual filings. If a retailer's slice of total e-commerce sales ticks from 15% to 20% over 5 years, there's a moat. If it slides from 8% to 4%, the moat may be eroding faster than you think. Putting it all together, your moat checklist. Grab a spreadsheet or even a simple notepad. For any stock idea, run through these 6 rules in under an hour. Margins. Are they consistently above industry average? Switching costs. Would customers dread leaving? Legal barriers. Are patents or licenses in place? Network effects. Does more usage equal more value? Pricing power. Can prices rise without losing volume? Market share. Is share stable or growing? Use publicly available data, SEC filings, investor decks, free research summaries, and trust the patterns. You don't need perfect numbers, just consistent signals. If most boxes tick, you've spotted a fortress stock, one that stands firm when market tides turn. That's the moat mystery cracked. 6 straightforward, actionable rules to uncover durable competitive advantages. No fluff, no generic pep talk, just the tools you need to start hunting moats today. Next up, we'll figure out how much to pay for a fortress stock without overcommitting your capital. For now, grab your checklist, pick a company you know, and see if you can spot the moat in the wild. Chapter 5. The Safety Net. Calculating your margin of safety. You're eyeing an energy company whose stock price has doubled and then crumbled by half in the last 2 years. The financial headlines scream by when oil prices spike and sell when they slide. You don't want to be the person who bought at the top and got burned. That's where the margin of safety comes in. A simple cushion between what a company is really worth and what you pay. In plain English, it's your built-in protection against mistakes, bad luck, or sudden market swings. Let me show you, step by step, how to build that safety net using a basic discounted cash flow, DCF, model. And trust me, you don't need a finance degree. First, you need real numbers. The company's free cash flow, FCF. Head to its annual report on the SEC's website, or use Morningstar if you'd rather click around. Find the last 5 years of FCF. These are the dollars left over after the company pays all its bills and reinvests in its business. Write them down in a clean Excel sheet. Year 1, Year 2, Year 3, Year 4, Year 5. Now add those 5 numbers and divide by 5. That gives you the average cash flow, but don't let it fool you into optimism. We're not bankers, we're value hunters. Multiply that average by 0.8. This shaves off 20%, letting you assume things might not be this rosy going forward. Next, forecast future cash flow. Instead of projecting heroic growth, assume cash flow will stay flat or even dip slightly. A good rule: use 75% of your adjusted average for year 1 forward, then hold it constant for a decade. That way, you're not betting on an energy boom, just steady business. List those 10 years of projected FCF in another column. Now comes the discount rate, which shrinks future dollars into today's buying power. Don't overcomplicate it. Pull up the U.S. 10-year Treasury yield. Right now, it hovers around 3%. Add a risk premium of 5% for energy sector volatility. You get an 8% discount rate. In Excel, use the NPV function. Type equals NPV 8%, and then select your 10-year cash flow range. Hit Enter, and Excel spits out the present value of that decade of cash flows. But we're not done. After year 10, the business doesn't vanish. It keeps generating cash. To capture that, Calculate a terminal value by taking year 10's cash flow, dividing by our discount rate, 8% here, then discounting that lump sum back 10 years at 8%. In Excel, it looks like equals year 10 cash flow slash 0.08 slash 1 plus 0.08 caret 10. Add that number to your NPV total. This grand sum is your intrinsic value for the whole company. Now compare intrinsic value per share to today's market price. Suppose your model says the company is worth $50 per share. If the stock trades at $33 or less, about 2/3 of intrinsic value, you've built in a 33% buffer. That's your margin of safety. If the price is higher, don't force it. Energy stocks bounce around, and you want room for error. Here's a key tip: always round down. If your model spits $50.80, treat it as $50. If the market price is $34.20, treat it as $35. That tiny rounding shift widens your cushion. And if your projection assumptions feel even a bit optimistic, shave another 10% off your intrinsic value before comparing to market price. This is your personal safety net. Overbuilding is fine. Underbuilding gets you hurt. Let's talk worst-case scenarios. What if oil drops 30% next year? Rerun your model, assuming year 1 cash flow is 30% below your adjusted average, then hold flat. Recalculate. If the stock is still 2/3 of that new number, it's still a yes. If not, pass. By stress testing for a bad oil slump, you're not betting on disaster. You're preparing for it. Another actionable rule: update your model quarterly. Every earnings report brings new cash flow data and fresh guidance. Replace the oldest year in your 5-year average with the latest number, readjust by 0.8, and re-NPV. This keeps your intrinsic value current without reinventing the wheel. Finally, cross-check with a simpler multiple. Divide enterprise value by trailing 12-month cash flow. This is the EV/FCF ratio. Compare it to peers. If this company sits at 8 times and the sector average is 12 times, that's another green flag. If it's trading at 16 times while you modeled 10 times, something smells off. Always triangulate. In short, you've just built your margin of safety net in under 10 minutes. Grab 5 years of free cash flow. Average, then shave 20%. Project that safe cash flow for 10 years. Discount at 10-year Treasury plus 5%. Add a terminal value. Round down your result. Require a market price 2/3 below your number. Retest for a 30% slump. Update quarterly. Cross-check with an EV/FCF multiple. Do this every time you look at a cyclical stock and you'll sleep better at night, knowing your portfolio has room to absorb shocks. That's your margin of safety. The art of buying with a guardrail, so you can focus on the one thing you control, your own discipline. Chapter 6. The Dividend Whisper. Reading cash yields as clues. Picture Sarah, a semi-retired schoolteacher who discovered she could top up her monthly income by investing in dividend stocks. In her first month, she collected $20. And that might sound small until you remember she only needed a handful of shares to get it. That moment lit a spark. Dividends can be quiet money machines if you know how to read their signals. This chapter isn't about chasing the flashiest headline yield you see on the broker app. It's about decoding the whispers behind each payout so you can find stocks that stash cash in your account without fear of sudden cuts. Let's start with the yield itself. If you see a 6% yield, your first gut reaction might be excitement. But high yields can mask trouble. Companies in distress often lift payouts to lure investors. Rule number 1. Compare today's yield to its own 5-year average. If evergreen utilities usually yields between 3% and 4%, but now shows 6%, alarm bells should ring. That gap often means the payout is stretching the business beyond its means. Next, check the payout ratio. In plain terms, the payout ratio measures how much of a company's profits, better yet, its free cash flow, goes straight into dividends. Aim for a ratio under 60% when measured against free cash flow. That leaves room for new projects and a buffer in downturns. Take Greenfield's agribusiness. They generated $100 million in free cash flow last year and paid out $50 million in dividends, giving a 50% ratio. That cushion let them raise the dividend 2 years running, even when crop prices dipped. But free cash flow can swing wildly, so dig into the trend. Rule number 2. Demand at least 3 consecutive years of free cash flow coverage above dividend payments. If WidgetWorks covered its payments twice but fell short in year 3, the payout might be living on borrowed time. Consistency builds trust that your monthly checks won't disappear. Always pull a simple chart of cash flow versus dividend spend for the past 5 years. Most broker platforms let you export this data in minutes. Now, let's talk history. Nothing speaks louder than a track record of unbroken dividend hikes. Rule number 3. Look for companies that have increased dividends for at least 5 straight years. That's your peace of mind metric. Blue Chip Pharmaceuticals has managed 16 years of annual raises. That company treats dividends as sacrosanct. Firms with that level of commitment treat shareholder payouts like rent. Priority number 1. Sector context matters too. Utility companies often yield between 3% and 4%, consumer staples around 2% to 3%, and REITs around 4% to 5%. If you spot a utility yielding 5.5%, dive deeper and probably pass. Rule number 4. Frame any yield against its sector median. That prevents you from buying what looks like a bargain but is actually a yield trap. Here's a practical tip on execution. Set up a simple spreadsheet or even sticky notes. Track these 4 metrics for every stock you consider. Current yield versus 5-year average, payout ratio, free cash flow coverage, and years of consecutive raises. Update it quarterly. The act of reviewing cements your understanding and flags trouble faster than passive watching. Finally, think about reinvestment. If you can't immediately spend dividend checks, enroll in a dividend reinvestment plan, commonly known as a DRIP. This hooks your payouts back into the same stock without commissions, compounding your position. But beware taxes. With most broker accounts, you owe income tax on dividends the year you receive them, even if they reinvest automatically. Factor that cost into your monthly cash needs. By following these specific rules, you're not chasing fads. You're listening to the dividend whisper. You'll know when a payout is a siren song and when it's a genuine sign of corporate health. Sarah's $20 discovery turned into enough income to cover her utility bills, and it started with these clear, actionable steps. Now it's your turn. Line up the numbers, check the history, and let the quiet power of dividends work for you. Chapter 7. The Sector Compass. Navigating Tech, Healthcare, and Staples. Imagine you're scrolling through your brokerage app and wondering why your tech-heavy picks soared 1 month and then plunged the next. You've heard that healthcare stocks are defensive and consumer staples are boring but safe. But when do you actually pull the trigger? In this chapter, we'll turn that confusion into clarity with 3 simple, real-world rules you can start using today. Let's start with tech, your high-octane thrill ride. Tech companies get punished when borrowing costs rise because their future earnings, projected years ahead, suddenly look less valuable. Here's your action. Once a month, check the 10-year Treasury yield. If it climbs more than a quarter point from your last check, sell 10% of your tech position. That quick, mechanical response prevents you from waiting too long and losing half your gains. You don't need fancy software, just a sticky note on your monitor or a calendar reminder. This rule wrests emotion out of the equation and locks in profits before higher rates hammer valuations. Next, shift your compass toward healthcare. These are the companies that make the medicines and devices people rely on, even in a downturn. But not all healthcare stocks are built the same. Some flop because their drug pipeline dries up, others soar because they have multiple phase 3 trials lined up. Here's how you cut through the noise. Build a 1-column spreadsheet listing each biotech or pharma name you own. Beside each, note the count of active phase 3 drugs or FDA approvals in the past 3 years. If a name reads 0, that stock stays sidelined. If it's 3 or more, consider adding 20% to your holding. By focusing only on those with proven late-stage assets, you avoid the lottery tickets and ride the next FDA nod straight into your portfolio. Now let's anchor your ship in consumer staples, the companies selling toothpaste, coffee, and laundry detergent. They don't make headlines, but they deliver steady cash flow when everything else is melting down. Your shortcut: scan for brands that control at least 15% shelf share in 2 or more major retailers. How do you find that? A quick Google search of brand X shelf share Walmart Kroger will pull industry reports or press releases. If the brand you're eyeing doesn't clear that 15% bar, skip it. This simple metric weeds out niche or upstart brands that look cheap but lack the pricing power to maintain profits in a recession. With these 3 rules in your toolkit, you've effectively built a rotating strategy. Tech gets trimmed when rates rise, automatic profit taking. Healthcare gets topped up when you see real pipeline depth, quality over hype. Staples get held only if they pass the shelf share test, durable cash flow guaranteed. Every quarter, set aside 30 minutes, no more, and run this checklist. Mark your 10-year yield change, update your spreadsheet of phase 3 counts, and Google your Staples shelf share. Then rebalance accordingly. That's it. You're not predicting interest rate pivots, FDA decisions, or consumer trends. You're reacting to concrete signals that matter. One more pain point. You'll feel FOMO when tech rockets while you've shifted into healthcare, or envy when staples grind higher while your growth stocks stall. Here's your counterpunch. Maintain a target allocation of roughly 40% tech, 30% healthcare, and 30% staples. Allow a 5% drift before rebalancing. That cushion lets you capture momentum without derailing your long-term plan. By treating each sector like its own mini-business, governed by a few hard rules, you squash guesswork and guard against regret. Tech's high beta gives you upside, and you lock that in before it turns. Healthcare's regulated pipeline rewards patience, and you back winners only. Staples' shelf dominance gives you stability, and you avoid the pretenders. Run this sector compass religiously, and you'll turn what feels like guessing into a reliable system that works in boom times, busts, and everything in between. Chapter 8: The Long Game: Building a Diversified Portfolio. Welcome to the final stretch, where patience and structure turn good picks into lasting wealth. You've learned to spot value, but now you need a system that keeps you from betting the farm on one idea. Diversification isn't a luxury, it's your safety net. In this chapter, you'll get simple, actionable rules to spread risk, capture opportunity, and sleep soundly when headlines turn sour. First, limit yourself to 8 to 12 stocks. Too many, and you dilute your best ideas. Too few, and one bad outcome can wipe you out. Pick stocks across at least 4 different sectors: technology, healthcare, consumer goods, financials, to ensure that industry-specific downturns don't drag your entire portfolio down. Use a free stock screener to filter for your top value candidates in each sector. Then narrow each list to 2 or 3 names. This keeps you focused without overwhelming your decision process. Next, cap any single position at 10% of your total portfolio value. If you start with $10,000, no more than $1,000 goes into one company. This rule stops you from emotional overcommitment and forces you to treat each judgment equally. To calculate this, open your brokerage's portfolio view or a simple Excel sheet. Enter your current total and divide by 10. You'll immediately see how much to buy or sell to maintain discipline. Now, establish 3 core holdings that you believe in for the long haul. Companies with strong balance sheets, steady cash flow, and visible competitive moats. These are your bedrock positions, each making up 6 to 8% of your portfolio. Think of them as the foundation blocks. You don't trade them often. To choose cores, look for names you're comfortable holding through recessions. Perhaps a big bank with 10% ROE, a consumer staples brand with decades of dividend growth, or a software leader with recurring revenue. Keep a live tracking spreadsheet. Create columns for ticker, purchase date, cost basis, number of shares, current price, market value, and percentage of portfolio. Update it monthly, no more than 5 minutes. This document is your North Star when markets get messy. If a position drifts more than 5% from its target weight, flag it. We'll rebalance in a moment, but spotting drift early prevents panic decisions. Supplement individual stocks with 2 sector-specific ETFs, one in tech and one in healthcare, for example. Allocate no more than 10% combined to these ETFs. They act as satellite positions that fill gaps you can't research deeply. If you see a promising small-cap opportunity in renewable energy but lack time to vet every company, an ETF gives you exposure without the homework overload. Set a calendar reminder on the first trading day of each quarter to review allocation and rebalance if needed. If any position exceeds its target by more than 5%, trim the excess and redistribute evenly across underweight names. Use your spreadsheet to calculate the exact shares to sell or buy. Automating this reminder prevents you from chasing hot headlines and reinforces a disciplined, data-driven habit. Adopt dollar-cost averaging to ease into positions. Instead of investing your full allocation at once, divide it into 4 equal purchases spaced 1 month apart. This simple tactic mitigates timing risk and smooths out cost fluctuations. Many brokerages allow you to schedule recurring buy orders. Set it and forget it. Mind your tax buckets. Use tax-advantaged accounts, IRAs, 401(k)s. First for your core holdings, since you plan to hold them indefinitely. Place higher turnover positions, or ETFs, in taxable accounts where occasional capital gains tax is acceptable. This structure maximizes after-tax returns without complicating your strategy. Finally, resist the urge to tinker. If you follow these rules, 8 to 12 stocks, 10% caps, 3 core holdings, a live spreadsheet, 2 satellite ETFs, quarterly rebalances, DCA, and tax-smart placement, you'll have a diversified portfolio built for the long game. Over time, small, consistent steps trump big, risky bets. Stick to the plan, trust your process, and let compounding do the heavy lifting. The end. We hope you've enjoyed the audiobook. This audiobook is a production of Wealth Books. Copyright 2025.